Alan, this weekend, Standard Life and Aberdeen Asset Management confirmed that they are in talks about merging their businesses, and this morning they've said they would like to proceed with that deal. What's the motivation for the merger?
I think for one thing really is Aberdeen has had a lot of outflows over the last 4 years or so. 105 billion has flowed out of their funds. They're down to 300 billion, so they're hardly a small fund management group. But that's revenues, and that hurts when your costs aren't moving down as quickly. So they need to cut costs no matter what. Standard Life also has had some performance problems over the last year. So the two companies together are probably thinking we can cut costs and get some scale benefits here in the next 2 or 3 years.
And how quickly are they hoping to cut costs?
They are saying by the end of 2018 they will be generating 200 million of annualized cost savings every year. But they're also saying that they have restructuring costs, redundancy costs, which will be around 340 million. So split that in two, 150 million a year, 200 million benefits. It's going to take probably into year 3 before we really see the full benefits. So Madison, my turn to ask a question now is, these two companies are active fund managers, that's what they're known for. What does this say about active versus passive fund management when you're just following the indices? There's been pressure on these companies, hasn't there?
The vast majority of analysts are saying this looks like a defensive deal because both companies are under pressure from the constant rise of passive investing, which has basically meant big outflows for active fund managers that try to beat the market, and substantial inflows for companies like BlackRock and Vanguard, which have huge index tracking fund ranges.
Yeah, and Vanguard has had a lot of inflows, hasn't it?
Vanguard's inflows have been tremendous. So last year it pulled in more money in 1 year than its 10 nearest competitors combined.
Yeah, and they're the index kings, but are surprisingly also known for some active fund management, you said.
They also, so it's not quite 50-50, but Vanguard also have quite a big active fund range, which is also putting in a good amount of money. So the other factor here comes back to costs and fees. So Vanguard is capable of cutting its fees all the time.
Yeah.
It's harder for other big active fund houses to keep doing that unless they themselves keep control of costs. So this is seen as an attempt to build scale, cut out redundant costs, and in turn it will help the combined company. So whether it's called Standard Aberdeen or a combination of those two names.
It's going to be smaller in terms of a workforce.
Exactly, which in turn maybe will allow them to cut fees as well, and that's how you keep growing. But obviously this deal isn't just about the threat from passive, it's also about trying to build scale in order to compete with the investment giants like Vanguard, BlackRock, and they all seem to be over in the US. So forming a UK powerhouse, how important is that?
Well, I think the scale benefits are there potentially, right? And that is, Standard Life has been adding other fund management firms over time. So has Aberdeen. They've been trying to build up scale, and so they're bringing together is a big, massive leap forward. You're sharing trading, back office, fund managers. There's a lot of stuff where you could, share costs and spread those out over the assets and maybe improve your profitability better than it has been. So I'm not 100% sure that bigger is better for for the consultants that lead clients to the Standard Life and Aberdeen fund managers. Okay, so that's what we have to watch longer term. Is bigger better? We'll see.
Well, we'll start asking a few questions to the big investment consultancies. Thank you, Alan.